This past week, we had the big three. About the economy, we're going to show you what's working, what's not, what's really missing. We're going to try to answer the question, are we on the road to recovery or on the precipice of a recession? This week was reported GDP. Growth remained stable. We're talking about the gross domestic product. That was released at a level of 2.8%, anywhere between 2 to 3%. That's good, moderate GDP. It is down a hair from the last quarter, but nothing to be concerned about. Inflation is declining, but mostly due to food and energy. Personal consumption expenditure on a year-over-year basis, that's been on a long slide to the downside, 2.1%. That includes food and energy. Weaker gas prices, lower oil prices, that contributes to the PCE. But core inflation, excluding food and energy, is stable for the past 5 months, but it's not declining. We're still at a rate of around 2.7%. More or less, that's where we've been for about 5 months now. So if you take out food and energy, well, inflation's still a little bit too high. Employment does not look good. We had the non-farm payroll. That was released at a level of 12,000 jobs, just above zero. They revised down the last two numbers as well. The last number is 223,000. Now, the fact of the matter is government jobs, well, that created 40,000. So if we exclude the government jobs, non-farm payroll is actually a lot worse than we'd like to see, certainly. The labor force participation rate, that's at 62.6, just a hair down from 62.7. It's not a big drop, but we'd like it to see go up. Does 2024 look like a recovery year? Let's look at prior recovery years. Here we can see these are the yearly averages, the numbers for the entire year. This year, we have 170,000 jobs created per month on average. Employment slowing. We don't want to see non-farm payroll in the 170 level. We see PCE, personal consumption expenditure. Consumer spending is cooling, 2.5%, down a lot from prior very hot inflation numbers. GDP, growth is stabilizing. 2 years ago, we had a meager 1.3%. Last year, 3.2%. So it's stabilizing, and that's a good thing. Going back to 2011, now keep this in mind, we're looking at years that represent recovery years following a crisis. 2024 might be a recovery year from the COVID crisis. 2011 certainly was a recovery year following the financial crisis of '08. We had 172,000 jobs for the average for the year. That's kind of like where we are now. The job market was recovering. As far as consumer spending, it was improving 2.5%. Now, of course, we know our consumer spending, it's coming down versus in 2011, it was rising. It's a different animal. In 2008, we had a financial crisis. Inflation went down quite a bit into the negative, actually. Currently, we're fighting a different battle. The battle is inflation. So inflation is moving in opposite directions. And as far as weak economic growth, well, that's not a number we want to see. 1.6%. It was recovering. We actually had, of course, the recessions, 2 negative quarters of GDP. 1.6% was a recovery, certainly not where we wanted to be. Let's take a look at 2004. That was a recovery year from the dot-com bubble. The jobs market at this point was recovering at 170,000. That's this year's average also. Prior to that, in 2003, it was 10,000, and prior to that, it was actually in the negative. Consumer spending was improving also. It was a major sell-off, and now we have 2.5%. That was a good year. And growth was stabilizing. 2 years ago in '02, it was 2%. '03 was 4.3%. So it's stabilizing, just like where we are now. So the question remains, are we in a recovery year? Do you think we look like the way the economy looked in 2011 and 2004? Or 2024 also might look like an economic slowdown year. We can see, for example, this year, of course, 170,000 non-farm payrolls were reported. We'll go back to the year 2000, following the dot-com bubble. It was just the top, actually. We had only 161,000 jobs on average created that year. Keep in mind, in the 90s, you had 265, 254, 284. That was the weakest year in quite a while. in terms of consumer spending, well, it peaked at that point also. There was actually moderate inflation, believe it or not, all through the dot-com bubble. That's what makes that era so remarkable. We had great job growth, great corporate earnings, but moderate inflation. And then we had a big drop in GDP. That really told us what was coming. Take a look at the GDP numbers for 99, 98, 97, almost at 5%. Those were miraculous times with almost 5% GDP and very low inflation. So, what's in store for us in 2025? Well, first of all, non farm payrolls. We need jobs to improve, but that will only occur with corporate earnings. And as far as corporate earnings, it's not just going to be AI. It's not just going to be NVIDIA. We need a broad recovery in terms of corporate earnings. We're in the middle of corporate earnings season. True, some companies are posting great numbers. A lot are not. We need the strength to be more spread out. In terms of consumer spending, that should also improve, but it shouldn't improve faster than salaries. Salaries need to rise faster than inflation. So consumer spending should go up, but the non-farm payroll, that should go up more. And as far as GDP, well, there's one key element that's missing. It's a major point within the GDP number. It's manufacturing. We have not had any good news in terms of manufacturing for quite a long time. We talk about the Empire State Index, the Philly Fed Index, others as well. None of these numbers are good. And that's what's really missing from the GDP. So we're going to keep an eye on all of these barometers moving forward very carefully to look for signs, to look for leading indicators that would allude to a growing job market, rising consumer spending, but again, jobs should rise faster than consumer spending, and GDP, we need to see some better manufacturing numbers. We hope this has been helpful. We look forward to seeing you back soon.